All right, here we go. Good afternoon, everybody. Glad to see we have some folks online. I was a little concerned about such a nice day that everybody would be out and about. And why would you be wanting to talk about a down stock market, you know? But anyhow, let's quickly go through this. Um, we we usually put our disclaimer up here, which says that you should take everything we say with a grain of salt. So by all means, please do so. We don't want you to go off and make investments without checking with your investment professional and so forth. This is an income group, and so we concentrate primarily on income investing and so forth, and sustainable streams of income. And I encourage everybody to be an active investor. Just to give you some background, we've got guys on this group who are very active, and I want to encourage everybody to be so. I know Ron and Chuck are working on a spreadsheet that we think we can share with everybody, and I know that there's other people who have offered to do some work for spreadsheets and stuff like that. This is how we learn from each other. This is how we share information. And so I know that you guys are mostly professionals who are retired. And so you bring to this group extensive knowledge throughout your working careers. And so this is valuable information that can help us become more intelligent income investors. And so I encourage you to step forward and do give us some ideas. And then, of course, as everybody sees this before, we're primarily aiming at people who are approaching retirement or in retirement. And let me stop here for a second and talk about the Google groups and what's been happening there. Behind the scenes, I have talked to Todd Blinkenstaff, who's our president for the chapter here. And the AAII headquarters in Chicago wants us to move over to a different platform than Google Groups. They call it their community platform. And so I have signed up on the income group on that platform, and it's pretty good, but it has some limitations that I'm not sure I know why. And so I've put in an inquiry to headquarters to ask them to give us some information about this, because we're going to do some tire kicking on this thing. Maybe later on this year, we'll switch over to that platform and just drop Google Groups. And the nice thing about it is I'm hoping that we'll be able to share files up there and put the videos up there all in one place. And so whenever you go to the AAI PDX Income SIG, you'll see the dialogue for all of our communications back and forth, and then you will be able to access the videos, and there'll be a folder there where you can access the files, the spreadsheets, and anything else that we as a group put up there. There's going to be some tire kicking between now and if we ever switch over to this thing. So I know that David Page is going to help me with this. Maybe if we can get one or two more guys to help with the tire kicking, that would be nice. Just send me an email if you'd like to be involved in that. That'll probably take place over the next 2 to 3 months while we get familiar with it. Or maybe we may not use it at all. It depends on what features they really offer us. So I just wanted to give you guys some background about that. So because some of you are bashful about using Google Groups, and that's understandable. And so I'm thinking maybe this other platform might be better for us. And it ties into AAI headquarters a little better too. So any comments or questions about this before I move on, by the way? Well, okay. Just to move on then, I exchanged emails this morning with Todd, and he's working on some speakers for the fall, which would be, September, October, November. So there'll probably be some announcements later on next month or the following month. The other thing I meant to mention too is we won't have a meeting in August. We'll resume in September, simply because most people will be on vacation or out of town. So just mark your calendars for September, basically. Here's our YouTube channel. This is where we keep all the videos for the chapter meetings. So by all means, don't hesitate to visit that if you want to look up some of the past meetings and so forth. Okay.
Andy, are your slides changing?
AAI Portland YouTube channel. Is that slide up there?
Yeah.
Okay. All right. All right. Sorry about that. Okay. So,
full screen, Andy.
What's that?
If you want, go full screen.
Well, can I do that? Let's see here. Oh, no.
Good afternoon, everybody. This is Andy Prophet.
There's full screen.
Yeah,
that's
well,
full screen.
it keeps going to my recording, and I don't want that for some reason or other. Oh, boy, I'm going to have to stay with this screen. I'm sorry. Can you see yeah, all right, I'll just stick with this because something's goofy with my PowerPoint.
So did you show a different slide when you were talking about the change from Google to the new server or whatever it is?
Yeah, this is our typical one that I put up at every meeting, folks, about the Google Groups. And I was just saying that as a side to that, we're thinking of switching over to the AAII Community platform. But I would frankly like to do some tire kicking before we do that switch over, because if it's no better than Google Groups, why should we switch? The limitation in Google Groups is I think it's very awkward to use. And I know that some of you guys have complained about that. And there's no place to place files.
Today.
Pardon?
I couldn't get on Google. I tried for like 10 minutes. I'm not very good at a computer, so I got on with Zoom.
Okay. We think that the AAI Community platform might be a better choice for us because they tell me that they can offer a place where you can have files posted and also videos. And so I'm thinking maybe that might be a better platform. A lot of the chapters are adopting it at the chapter level. And so I'm saying, well, geez, we're just a little SIG here focused on income. Could we be involved in that as well? And they said yes, but I don't know how you go about displaying the files that are available or the videos that are available. So that's where the tire kicking has to come in. And so that's the kind of thing I would like to play around with a couple of other people from our group to see if we're really comfortable with that before we actually switch over from Google Groups. Just by the way, for your information, there are 90 people listed on the Google Groups for the income SIG. So there's a lot of people there. A lot of them don't attend the meetings, but they're on the list. And so I'm obliged to accommodate them, so to speak. So let me go back down to the agenda here for a second. And, behind the scenes here, about 3 or 4 months ago, I came across a tax calculator online that I thought was interesting. And so I sent a copy of it to Ron and to Chuck and said, hey, could you guys take a look at this and see if this would be something that we could share, come up with our own tax calculator that we could offer to our members here in the SIG. And they've been working on this thing. And I just want to give a little status report on it. You might want to, Chuck, do you want to take over the screen and then show us
Sure.
what you've got so far and what the progress has been? And then
Okay.
we'll stop there. I'll stop sharing.
Gotta get back to where it was.
Yeah.
So can you see this spreadsheet?
Yes, I can. Yeah. Mhm.
So this is what we started working with. So the important stuff is in this box on the left. So basically it's we call it it's a tax equivalent yield calculator for 2022. So right now it's got data from the 2021 tax tables, but you can go in and select your state here. So for example, this spreadsheet has all 50 states in it. So you can pick, any one of those states. And then it will then allow you to enter your taxable income amount. And then it'll use this table here in the center in these columns U through W to compute what your tax rate would be. It shows up in this box here, showing 12% for this $40,000 figure. And then likewise, it'll go, depending on which state you pick, it'll compute your state tax rate. And what this app does, it goes through a lot of manipulation of the data. And as you change, well, you'll see if I actually change this to say, let's pick another state, Pennsylvania, you'll see this data over here change. So what it does is there's a big table on the right-hand side for every state, and it basically duplicates, depending on which state you pick, it goes to the particular set of columns and it grabs that data and then it replicates it here on the screen. And then it does the calculation of this tax rate based on this amount of $40,000. And as you can see, this has done the calculation right up here. This cell right here is the amount of the tax rate for that state. And then this gets copied over into this table. And then down below here, you're able to then select a type of bond or savings that you want in this little box. And so you're basically picking one of these categories that you see down below. And then what this spreadsheet does is goes and does the calculation based on the yield that I think you're looking for, and it'll show you what the tax equivalent yields for these other types of investments. Anyway, this was sort of complicated. Well, you can see it. Well, if I click on one item here, for example, if you see at the top here, this is a calculation you have to go through. It's fairly long, and it's basically, if you know anything about Excel, you can click on a tab and then say to compute that number, what is it based on? And this is showing you to compute this this tax rate return or whatever. It's using all this information that's been either computed or selected. And so it gets kind of complicated. These formulas change based on, which one of these types of investments that you pick. So one of our challenges was to take this information and try to reduce it down. And so that's what I worked on. And so now we have the same table here in the box with the relevant information, but I've gotten rid of all the rest of the states, and I've gotten rid of the intermediate columns and rows here that did some calculations. So we had picked to do this for 3 states. So you can see the federal tax rate is the topmost table. And then there's Oregon, California, and Washington. It's what we've done. We haven't quite made a determination of what these figures, I didn't pay attention to when I looked at the tables that they used, if they were using like married, filing jointly or head of household or single or whatever. I just replicated what the other spreadsheet did. So anyway, this is a work in progress. I think it's working for this information so far. I'm still working on this calculation here, which I didn't have time to finish it up today. I worked most this morning on this. And anyway, the questions that we have deal with these tables. Do we really need a table for single and married filing separately, married filing jointly, head of household, etc.? Because if we do, we'd have to change the tables and add a lot more information to it. We'd also have to have a query here as to what are you interested in, married filing jointly or whatever, and then have it look up the appropriate table. So that's kind of where we're at, but this is definitely simplified, from the other spreadsheet that we had. So
Yeah, so and then Ron was involved in this as well. He actually computed the actual tables for this as well. So I guess the question for the entire group is, do we really need the 4 tables? My first reaction to it when they showed this to me was, oh, just married filing jointly and leave it at that. Or maybe single, or just the 2 categories rather than all 4. I don't know. What's the consensus from the group? Do we really need all 4 of these tables? Because this is going to make it very, very complicated for Chuck and I know for Ron as well. So what do you guys think about this? Do you have any feedback for us on that?
My input is married filing jointly.
We can hardly hear you.
Sorry, just 1 second.
Hello?
Yeah, can you hear me now?
Yeah, we can. Yeah.
Okay, I got my headphone on. Sorry about that. So my input is that married filing jointly or single, that should be adequate.
Okay. Yeah, that's kind of what I'm leaning toward too, but I wanted to get everybody else's feeling on this. Anybody else have any other strong feelings about this?
Well, if you want to make it simple, you could have 2 Excel sheets, one for single and one for married file jointly.
Yeah, we could do that.
That'll make the implementation easier and it'll be easy to choose.
Yeah.
it's true.
The other question we have is, do you want? We were thinking of narrowing down the number of state tax to 3 states: Washington, Oregon, and California, because I think that's where most of our members are. Ron, were you having some difficulties getting the California tables, or is that what you were saying?
California hasn't put out the 22 tables yet.
Oh,
At least publicly. I'm sure they've got them, but they haven't put them out publicly. So it would be a matter of I guess putting in the box there, which is where the data finally comes up that you read, which, if you're doing California, which year are you looking at? Because right now you only have 21 rates to work against. So you'd be comparing federal 22 against California 21 when you're figuring out the equivalency of a state taxable bond in California. I'm not sure if that big a deal, but again, it depends on how people want to use this data.
well, the whole point of this is just to get you in the ballpark, and when you're doing, when you're considering your tax status on a particular transaction. So it's not meant to be, TurboTax or your tax accountant. It's just a get you in the ballpark kind of thing. I was thinking, we could have it for our group, I don't know, maybe you don't think the tables for California are going to change that much? Is that what you're saying?
Well, who the hell knows? But it's just, if all one wants is does my 3% muni equate to a 5% taxable? Yeah, it's going to change when you get the 22 rates, but how much is it going to change? It's not going to change 3%. It's going to change 0.5% or some number in that range, I would guess.
Okay.
So it's just how niggling are you getting with the numbers, or like you were saying, do you just want a ballpark? Gee, that 3%er is pretty close to a 5, so I can make my decision for other reasons.
Yeah. Okay. Ballpark, I guess, is what I'm thinking.
Yeah.
So maybe we just drop California. I don't know how many members we have in California, honestly. Anybody from the California group on this session today?
Excuse me. I'm from California, but you can use 21 as far as my input goes, because I don't think they're going to change that much.
Okay.
And Andy, if they do, I mean, to change the table, it's not difficult to do that.
Okay. All right. So I guess we'll move forward on this. Chuck, is this going to be too complicated with just 3 states and two single and jointly?
Well, I got the 3 states already in, adding the other, and assuming this is married filing jointly, I can confirm that, but adding the single probably shouldn't be too hard. The nice thing is it's only 2 items to switch between instead of 4. So I think would make it easier to do. And my preference would be, I guess, to have a drop down box that says, what do you want to do, single or married filing jointly? And then I could have it compute it.
Okay.
So I can work with that, I think.
All right. Well, we're not going to be meeting in August, so you've got some time to fuss with it if you want, and if it even goes beyond that, that's fine too. I just don't want to put too much work on you, so to speak.
Well, I'll probably have some time on my hands since I'm seeing a neurosurgeon on Tuesday. I've got a torn rotator cuff tendon and ligament. So I'm going to be having surgery, and I'll be in a sling here for a few weeks. So I may have some time on my hands since the trips I was planning, I'll have to cancel.
Oh, no. Okay. Well, sorry to hear that, but I guess it's to our benefit.
Yep.
If you call him doing this entertainment.
Yeah. Yeah. All right.
Yeah.
Well, okay. Great. I'll you can stop sharing now, and we can move on to a different matter here.
Okay, let me stop sharing.
Okay, let me share my screen here. Well, okay, I talked about the calculator, and I've talked about the AAII Community. If one of you, 2 of you guys can send me your emails to help me do the tire kicking on this community platform. I'm still waiting for community platform people to get back to me from headquarters. Maybe this is not an exercise that we'll do. If they can't provide a site where they can provide the files and the videos, it's probably not worth doing. But I'm hoping that they will be able to do that. And it will make it, I think, a lot easier for us as a group to move forward. And then we'd be in step with everybody else with all the other chapters as well. So
Andy, this is Chuck again. I since I may have time on my hands, I wouldn't mind doing some tire kicking for you to look at it.
okay, well, thanks very much, Chuck. I'll put you down then. I've got Dave Page, and between you and Dave and myself, I think that's probably enough. But as a third item here, I wanted to mention the Silicon Valley chapter is doing a tutorial video that explains how they go about doing their investing using ETFs. I know, Tulsi, you sat in on that thing. Do you want to give us a little summary of what's happened so far and maybe explain it to what's going on there a little bit?
Well, it was kind of inverted for me. I was more interested in the why, and Don started talking about the what and the how. So I was actually pretty happy towards the end when he was getting into the whys part. The other thing I found interesting was Gilbert's big picture. I thought was very informative. So
Yeah, by the way, Gilbert Ho does at the Silicon Valley Computerized Investing session. Every month he does a summary of the economy, which is very good. And it's well worth going to their site and looking at just that section of the video. It's a really nice overview of what's going on in the economy. Just for background for everybody else, we have a number of people in our group who prefer not to do investing on a fundamental basis. In other words, what I mean by that is they are not interested in looking at earnings or looking at cash flows or fundamental analysis to determine whether a stock is worthy of taking a position in or evaluating it and so forth. They would prefer to operate at the ETF level or at the mutual fund level and choose to select a portfolio of ETFs or mutual funds that optimize their income from a retirement point of view, from a cash flow point of view. And the Silicon Valley chapter has a mechanism for doing that. It's quite complex, to be perfectly honest, but it's well worth thinking about and looking at. And so Don Maurer is doing a tutorial that explains how they go about this. And he got about halfway through it at the Thursday night meeting. And he'll do the other half, I think, probably at some future session later on this month or next month. And when that tutorial is completed or ready to go, I will offer a link in our site so that you can go look at it if you want. It is very mathematical, to be perfectly honest, and some of you may be a little bit overwhelmed by it, but I think it's well worth looking at. If you're that type of an investor, if you're looking at ETFs, and of course, looking at the overall economy, I think is very important as well. And so Gilbert Ho's presentations are very, very good to give you an overview as well. So that's kind of the background of it. So just be aware of that. And if you want more information about it, just go to the AAII Silicon Valley Computerized Investing SIG site, and you can get more information about it as well.
Andy, do they have a partial tutorial up already before they do the finished one, or do you have to wait for the finished one?
I don't know. Did you know, Tulsi, if it's been posted yet? Have you looked at that?
he has not posted it. He has recorded the first session, and I have a feeling he's going to do the second one and before he posts the whole thing.
Okay.
And the other thing I was thinking was that even though I'm personally not interested in timing the market part of it, but I think it's good check and balance against our thinking. So if nothing else, it could serve as a check against our strategies on income investing.
Mm-hmm. Yeah. They have all kinds of timers that they use for their various approaches. I don't know how many timers were there. I don't even remember exactly. I mean, it must have been at least 30 of them that they were looking at, weren't they? It was huge.
I think 30 sounds right.
Yeah. And they had over 300 different strategies for the portfolios, and depending on your particular approach and what performance you wanted, which I think is far too many, but I think it's well worth getting a better understanding of what they're doing, and then maybe later on we can ask them to maybe reduce it down to, say, a fraction of that, so that it might be valuable to our income group here as well. So stay tuned, as they say, Any other comments before we move on, I guess?
Well, hi, it's Rich here. And yeah, I've been attending those meetings, and I think it's very worthwhile. The unfortunate thing is a lot of these algos are just risk off right now. And they really haven't done very well since last Thanksgiving, when the whole market has kind of changed. Their very best one right now, as of year to date, is called Live Mama. And it's up like, oh, well, geez, what is it? Year to date, it's up 2.5%. Then they have the S&P 500 Dividend Aristocrats, and that's risk off right now. So that's sitting in IEF, which is I guess like a medium term treasury. And that year to date is -9%. And then the one that's based on N100, that one is, yeah, that one's not doing good either. So the unfortunate thing is, and they're really working to kind of improve that, is, but I guess what's my point here? There's a wealth of information. It's the first Thursday of the month. It's a real good meeting to do. And then, like you said, Gilbert does a whole thing on Fred and talks about, everything from COVID to, yield curve inversions and whatnot, and keeps you posted. Like in 2 weeks, we got earnings season. So we probably got like a little, mini bear rally here that we could sell into before the bad news comes out. So you get some insight that way.
Yeah.
And I just, I'll be better at it. But I think it's worthwhile, and some of the returns are just phenomenal, just unbelievably good.
Yeah, the nice thing about this approach is that when you're in the market, so to speak, and in these ETFs, you do very, very well. But then there are periods of time, like Rich is pointing out, like from last Thanksgiving forward, you're in mostly money market ETFs. And so your cash flow would be, very small at that particular point in time. So the thinking is that, well, if you think of it over a long period of time, therefore, it all balances out and you probably do okay. So if you're willing to go with that approach, then it makes sense. It's a certainly a viable approach. I personally don't prefer not to do that, but I'm sure that there are many people who like that and like that approach, and don't like to do fundamental analysis. That's okay. That's fine. Everybody has their cup of tea. So it's well worth looking at. Yeah. But be prepared. It gets quite mathematical, to be perfectly honest. So, if the feedback is that they are a bit too mathematical, I can talk to Don, and maybe he can do a less mathematical version of it. If we want something done again. We had a couple of the guys from that group talk to us back in spring of last year, and so we could have them revisit it, and perhaps become less rigorous in that sense, and more income oriented kind of thing. Their portfolio approach is not just income; it's designed for capital gains as a whole group as well. Any other comments on that before we move on at all, or? Okay. Well, we'll move on to the current topics, and this is where it becomes an open discussion. Frankly, I'm excited about this market conditions, and I'm very excited about the next couple of weeks, because as earnings reports start to come out for companies, I think we're going to see some real opportunities for dividend investors. And I just tagged a couple of companies that I've been following here, T Rowe and Target and Lowe's and 3M and Cummings and Stanley Warren and Stanley tools and so forth I've been looking at as well, because they look like they're quite undervalued or going to be approaching undervalued. And what really intrigued me was, if you take the dividend aristocrats and you just looked at that particular segment of the market, and you looked at the amount of dividends that they're paying, those companies, that group pays, that particular group, who has been paying dividends for the last 25 years, I guess it is, and increasing those dividends, they may be opportunities in disguise as we move forward through this quarter and into the fourth quarter. Because what will happen is a lot of the companies will start to report their earnings, and the earnings will be down if the economy is really indeed slowing and going into a recession. So they may be opportunities in disguise for income investors, because you'll be able to pick up a aristocrat at a lower price, and they will not have cut their dividend. And so that's a very, very important time period for us. And so I have to look at these particular stocks because they're approaching that valuation point where they start to look very attractive to me. Cummings, which just to tell you a little bit about when I looked at it the other day, Cummings does a fair amount of business in Russia. And so, they've been hit hard because of the war in Afghanistan and the war. And so the result is that they are now scrambling to recover from that. So the stock price took a big hit because of that. But if you look at the earnings for the company, it looks pretty darn good. It looks even despite the revenue hit that they may take in their Russian market, so to speak. So it may be an opportunity in disguise. I don't know. I still have homework to do, and I wouldn't recommend it to anybody, but it looks very, very promising. And some of the other companies, not necessarily related to that issue, look starting to look very attractive. So now's the time to
Andy,
start looking.
if I may ask you a question,
Yeah.
Are you saying you're looking for one more bad earnings reveal as a really good entry point, or are you saying it's already here?
I think that most of the aristocrats that I've looked at haven't reported any bad earnings so far. Okay, and so my guess is there'll be some negative reports that'll come out in the third quarter and in the fourth quarter, and who knows beyond. So it's time to dust off your shopping list, so to speak, of those particular stocks, and start to look at whether they are in the value range where you can buy them, or within the valuation range. And so I think we're heading into a recession. I would think most people would agree with that. And so these dividend paying aristocrats will be an opportunity in disguise. It's a very important period of time for me. I think it's a great deal because you can pick up a stock at a much higher yield than you normally would not.
I have a question about one of these, well, a bunch of them, but in the Northeast, it's sad, but no one ever goes to Lowe's, it seems like, and everyone goes to Home Depot.
Yeah, same here.
And
Yeah.
I'm wondering, is it in the rest of the country, people go to Lowe's? They seem to be cleaner stores. But I'm just wondering because I'm in the Northeast and I know the Home Depots in Manhattan and in Connecticut and Long Island, but I'm just curious, is it just like a regional thing that in the Northeast, people go to Home Depot and then the rest of the United States, they go to Lowe's or what is it that differentiates those two companies in the sense of popularity? Because I would love to do something with Lowe's, but you know, I go and it's always deserted, and then the Home Depot is always mobbed, so to speak.
Well, I don't know. I go to Home Depot because they're so close by from where I live. And I was over there last weekend, and you would think that with the economy slowing down, you would think that it would be pretty quiet in there. Boy, it was not. I'll tell you that. It was, you could hardly get anybody to help you there at all. I mean, lines were long at the checkouts and everything. It was just unbelievable.
So why
Lowe's they have Lowe's out here, but you're right. They're not as common as Home Depots. There's no question about that. Yeah. But from a financial point of view, when you look at the business side of it, they look very good. They're a very well managed company, and by the way, is Home Depot as well. I think that both of them you could not go wrong with them. Now, can you pick the bottom for this market? Absolutely not. I would not. I would dollar cost average into it. Basically, what I was doing, and that's what I'll probably do. I'm already have taken a position in Cummings, and I'll be dollar cost averaging into it as it continues to move forward, because I think it's a very well managed company, and I don't know where the bottom is no more than anybody else is. So
now, do you think 3M is heading towards a further bottom, or have you started to do something with 3M because of the lawsuits, or is it what makes that attractive? I'm sorry, maybe I should be asking this right now.
Anybody else? No, I understand. I'm fully aware of the 3M lawsuits, but I think that the management at that company has already taken that into consideration, and they have adjusted for it. Maybe they calculated. Those things get stretched out over time. I mean, the lawsuits knowing the lawyers being what they are, they'll try to stretch it out as much as they can and reduce the risk as much as they can. So this is not going to get settled within the next 2 quarters. It's going to take years for them to get this settled. And so,
and 3M right now is at a COVID low, and I think it's a very steady income producing company. I have some. I'm going to buy some more now. I think it's in a good stage right now.
When do they report now? When are they going to report? And
this is our usual discussion.
Just to, I could fire up my.
No, that's okay.
If you want, Jack, I can fire up my fast graphs and show you if you'd like. We could use that as a speaking point if you'd like.
Okay, yeah, since that's interesting.
All right, let me see if I can do that.
While you're doing it, Andy, it's Rich. And I would say, Jack, where I live, we have a Lowe's right next to Home Depot. And it's exactly that. I walked into the Lowe's to see if it was good buy about a year ago. And a lot of them, it was dirty stock, couldn't find anybody to help. And a lot was empty compared to, just next door at the Home Depot. But I would temper a purchase right now, simply because if you go back 6 months ago, rates on like say home loans, and those businesses are driven by that appreciation in real estate, a lot of homes flipping and changing hands. But rates went from like say 2.5 up to like or went from 2.25 to 5.5, right? So interest rates doubled on home loans, which means that home sales are really going to start slowing down, or prices are going to start moderating. Certainly that increase blew the doors off of any refi company. So those banks I would steer clear of because no, you know, there's zero refis now because rates doubled. So I think what's happening in the market overall is that, you know, we were having this spectacular inflation, you know, 8-9% or, you know, double that on shadow sites and shadow stats and stuff like that. And then what's happening is you get inflammation. I got COVID on the mind. But, you know, so rates are going, you know, the inflation rate is still going to go up, but at a decreasing rate. It's still like, you know, you still got the same beta, but at a lower gamma. And then that kind of leads into the, everybody kind of agrees that we're headed towards a recession. So what it looks like to a lot of algos is like, oh, rates are going to be coming down. So then, you know, I'm going to be, you know, discounting my future cash flows and consequently the PE compression, you know, is going to be mitigated a little bit for a while. And then when things kind of get even more bleak, then, you know, the P's and stuff will drop down even further, you know, and that's when the real blood in the streets and the buys are. So as far as those home builders, I don't know, I would dollar cost average into them because they are good money makers. And if you look going backwards, they've been great stocks. But I'm just a little worried about the changes that we're looking at right now. You know, good time for me to keep my powder dry.
Okay, yeah.
Let's see. Yeah, I think that we're going to see some very good opportunities here. I just loaded up the 3M here. I can share that with everybody. I hope. Let me do that. And I'll go here. And I'll go here. All right, there we go. Here's 3M. And this graph requires a little bit of an explanation because it's based on fundamental analysis. It's called a fast graph, and it's a service that I subscribe to. Basically, let me start by getting rid of the price here. Yeah, this is a graph of the last 20 years for 3M Corporation. The shaded green area is the earnings for the company over the last 20 years. And then the blue line that you see at the very top of the shaded area is the average price to earnings ratio for this company during the last 20 years. And then you can see over on the right-hand side that it's tagged in blue as 14.99, or in other words, 15 times earnings, basically. Now, if you add the white line down below here is the dividends for this particular stock. And you can see that the dividend is much lower than the overall earnings. In other words, the difference between the white line and the top of the earnings line is a safety of margin. In other words, this is the amount of cash that they're throwing out to the investors, to the shareholders, and this is what they have left over, basically, in terms of earnings. So the safety margin is quite high on this particular company. And if you look at the credit rating down here, it's an A+ rated company. So this is a pretty safe company in terms of its credit rating. So then if you add the price on top of that, that's the black line. And what you can see here is that the price line varies widely around the price to earnings ratio. In other words, during the recession, the 2008 recession, the PE ratio got down to 6.9 there at the very bottom of the 2008 recession. And then, so, you know, any time during this period of time, you might consider this stock to be undervalued. Whereas up here, in this period of time from say 2016 to 2018 and 19, investors got a little enthusiastic about it, and the PE ratio went up to 23. And in the last 2 years, it's dropped dramatically, and the prices even dropped further. Yet the earnings have plateaued and are starting to climb. So this is a value. This is an undervalued stock, basically. And so buying any time that it's below the blue line is an opportunity in disguise. And so where's the bottom? I have no idea. I don't think anybody knows that. But if you dollar cost average into it, eventually you'll do fine, because eventually it'll correct. It'll self-correct. It always returns to the blue line, so to speak. So, and if you look at the performance for it, you can see here, for example, the dividend increases over the last 20 years. Granted, the dividend increase in 2021 is very, very small. It's less than 0.5% or 0.6%. So that's very small. But on average, if you looked at it over the last 20 years, it's 8%. So you take the 3% plus the 8%, that means that your total return is something well over 11%. And you can see that here over on the right-hand side. There's the performance of this S&P 500 for over that period of time, $5,925. And what you did in the 3M was $11,000 in dividend performance. And the dividend growth rate is that, and so in terms of growth, in terms of dividends and growth, you underperformed the S&P 500, but in dividends, you did much better. So, so basically, this is a good income stock, and so buying it at the right time makes a lot of sense. And my position would be, okay, let's look at all those aristocrats, because those aristocrats don't cut their dividends. They just simply don't. And so therefore, a lot of these guys are going to become bargains going forward. So I just showed you 3M. I could show you Lowe's. They all have the same characteristics. Maybe not as much. Let's see, LOW. Let me go there and show you that. Yeah, you can see here, huge spike in earnings at Lowe's, and then a nice forecast going forward. And then here's the current price of the stock, 181. So it's below its nominal price to earnings ratio. Oops, so I'm going to go back here and go to earnings so I can get this thing done right. Yeah. So this looks like to me a very, very a good opportunity in disguise. And
Andy, you might have a backup in that Value Line has 3M as a 4, which is basically a sell. So given that Value Line and dividends tend to head in opposite directions, you're probably absolutely correct.
Well, I don't know. I look at the Value Line portfolio 3 and 4 on a regular basis, and there are opportunities in disguise in there, basically, Ron. I don't know. Have you looked at anything there that you like, or?
I tend to not look at the portfolios except for change. And I go on look at individuals rather than that. But it just, again, given that Value Line is a momentum service, and therefore right now 3M does not have momentum, but that's not what you're looking for. You're looking for a dip in the long range price for dividend, which is to them, a different view.
Okay. Uh-huh.
And Andy, do you just, you look at your yield on cost only, or do you follow the price of the stock at all when you're deciding to buy?
I look at a combination of the yield. I'd like my sweet spot, I guess, is 3% dividend yield, and maybe a 6 to 8% dividend growth rate. That's kind of my sweet spot.
So it doesn't affect you or something, like the stock went in 2017, it was selling at 235, and now it's down to 129. You don't really care about that huge diminution in capital?
No, because I'm more interested in what the earnings are doing and how fast they're growing. And of course, earnings manifest themselves into cash flow, and the cash flow is what pays the dividends. So I don't know if I'm answering your question, William.
I just see somebody buying in 2017 has taken a huge paper capital loss while they're getting those dividends.
Well, are you talking about Lowe's, or which one are you talking about then?
3M I'm looking at. Is that what you're talking about?
Oh, okay. Let's go back to 3M here. I'll give you.
Maybe I got sidetracked.
Yeah, that's okay. Let's go back to there. All right. What year was that? Is that
2017-18? The stock was at a.
All right. I'll go to 2017 here. This is 2018. In my mind, this stock is grossly overvalued in 2017 at $238 a share. Because if you look at the blue line here, which is the nominal price to earnings ratio for this stock over the last 20 years, there's a deviation from the mean, or a regression from the mean, so to speak. So this stock is going to correct sooner or later. Now, when it does, who knows? But it does. It did. You can see that here. And then it undercorrected, and it even got down to 15 times earnings right there. And in fact, that green dot is where I bought it. But I also bought it here.
That was a COVID low, March 20th.
Yeah, and that was the COVID. Yeah, that's right at the bottom of the COVID thing. And now it's down here, which is under my, that yellow line through there is my average price on that. I see this as an opportunity in disguise, because if you look at the earnings are growing. And how many analysts are we talking about here? There's 14 to 18, 7, 10 analysts who are projecting on this company. Granted, they screwed up badly here, but if you look at them as a whole, they've done pretty well. Their track record on the company is reasonably good. And by the way, you can do this on Yahoo. You don't have to use Fast. Yahoo has the same information basically. So it's crowdsourcing the information from a bunch of analysts who are looking at this company much closer than I am. So I say that maybe these companies, especially these aristocrats, are starting to look like bargains. So William, I'm not sure I answered your question, but that's the kind of my line of thinking.
And the supply and demand is pretty steady, so I think it will be a steady income company.
Yeah, and here, as it's noted down here, this is an A+ company. This is not a schlock company. This company is doing very, very well. Now, what are the earnings going to be for here and here starting next week? I mean, they may come back and say, oh, we missed our numbers and therefore our earnings are going to be down. And so the stock price may drop even more. But my guess is it can't be that bad, because they would have seen that by now internally. So listening to what the quarterly report will be a good warning or early warning indicator of how this stock will do. Will it go lower? I don't know. I think it's looks like to me, it looks like a real bargain to me. Any other stocks that you'd like to look at? By the way, I'm welcome to.
Andy,
Um,
this is Chuck. I get this free dividendsandincome.com newsletter.
Yeah, huh?
And the one from July 7th said, there were 6 dividend growth stocks that just increased their dividends. And it was interesting. I assume I don't know how many years these guys have been paying out dividends because I didn't check the aristocrat list or whatever. But they mentioned that Caterpillar is up. They just increased their dividend by 8.1%. A company called KLA Corporation increased theirs by 23.8%. Kroger, same thing, 23.8%. They mentioned Target just increased their dividend by 20%. Morgan Stanley by 10.7%. And then the last one was United Health Group raised theirs by 13.8%. So it kind of caught my attention. I'm wondering, how well they're doing for them to suddenly be increasing their dividends after they've been paying them reasonably for a while.
Well, Caterpillar, for example, I know is an aristocrat. Well, maybe no, maybe this was a special dividend here. I don't know, but it's an A-rated company, and so just turning to Caterpillar. Yeah, Caterpillar looks like it's very attractive to me. I wouldn't hesitate to dollar cost average into this one if what is the dividend at? 2.68. Maybe I'd wait a little longer. I don't know. What I don't know. What was the other one, Chuck, that you had?
Well, there was it's KLA Corporation. And I think, let's see, they increased their dividend by 23.8%.
Well, I just screwed up here. What did I do here? What did I do?
I hit the wrong button and then got kicked out of the meeting.
Well, I just got screwed up too here. Hold on here. I somehow.
That fast graphs really looks like a great program.
Well, I just got kicked out of it. Oh dear. Oh well. No, Rob. Hold on here. Let me.
I don't think you're out of it. I think you go back to the Zoom, it'll come back.
No, I got kicked out, unfortunately. I'll have to go back into it. Hold on here. I'll just log back into it.
Well, Chuck, you mentioned United Health, symbol UNH. And I've never owned it, but I've liked that and never bought it, but I should have. And I always liked its unique position because not only do they fix humans, they also insure humans. So they play both sides of the fence. And I figured that gives them kind of a unique moat. They can insure, decide, oh, well, we're going to cover this thing, but we're not going to cover that thing. But it's overpriced. Look at that.
Well, they said this increase marks their 13th consecutive year of dividend increases. So
yeah, but
not quite the other ones, but
they're only yielding 1%. And
yeah,
Right.
that's the thing.
Yeah.
See,
That's
I
a
would
no.
wait for this guy to correct before I would. It's an excellent company. I own this one myself. The green dots here are my entry points, and I dollar
Yeah.
cost average into it. It's an A+ company. 17 times earnings on the nominal. Yeah, I would wait for it to get down to 386, maybe 432, somewhere in that range. I mean, the dividend, look at the dividends. I mean, that safety and margin is huge. I mean, that's,
Yeah, it's too high.
yeah.
Yeah.
Any other comments by the way? Yeah.
Andy, can you
Yeah.
check Allstate ALL?
You guys are picking all the ones I've been looking at. All right, Allstate, okay. I own Allstate, by the way, too. Yeah, yeah, they've had these declining earnings here and here, but the consensus is that that's going to jump quite a bit going forward. So, you know, I would wait on this one till maybe it gets down into the 110, 100 range, somewhere in that range. I think, you know, when the earnings report comes out for this quarter, they may take a dip, based on that, and you might be able to pick it up at a little better price or dollar cost average into it. It's a 2.69 dividend yield. Yeah, that's not bad, you know. So yeah, and they just had a nice bump in their earnings or bump in their dividends too.
Well, and if you're insuring cars and the cars aren't driving anywhere because it's $5-6 gas, you know, that's free money to them, right? Lower loss ratio, more profit.
Yeah.
Raise the rates and make more money on your margin anyway. Lower cost.
Andy, can you look at DVN, Devon Energy?
DBN?
DVN, David Vector Nancy.
Has a great dividend.
Yeah, about 7-8%, I think.
Whoa.
Yeah. Oh,
It's an energy stock.
Yeah. Well, to be perfectly honest, this is not my cup of tea. What is it that you like about this?
Well, it's oil and gas exploration, and I think the energy, even though now it's on a downturn, but I think the demand is not going away. So even though what you said about people not driving their car, I think the planet still needs energy. And
sure. Yeah.
Well, it looks like the earnings projection is huge, isn't it? I mean, that's, oh gosh, you're looking at.
It's one of the top U.S. independents. They have about 5,000 producing wells.
Oh, okay. Well, I'd say, you know, from a capital gains point of view, it might be a good bump. You might get a good, but from an income point of view, I don't know. It's not well, let's see, 6% dividend. Wow, that's it's hard to ignore, isn't it?
Yeah.
Well, it's a BBB, which is just above the it's just, you know, above what you call a risk level. I mean, so,
I'm just wondering why the dividend is expected to go down.
well, if you look at the cash flow, let's look at the operating cash flow and see what looks like they're projecting an upward cash flow. So that's good. But let's look at free cash flow and see what's going on there. Yeah, see, you can see the problem here.
Okay.
This is a very capital intensive company. And so the result is that their free cash flow varies widely. And in fact, you can see there were periods of time here where they had negative cash flow. So they paid a dividend, but where did that dividend come from? It had to come from somewhere else other than earnings. So I bet if you looked at the cash flow from operations or you cash flow from let's say borrowed money, you'd find that some of that is flowing into this dividend.
Okay.
So, and that's fairly typical of energy companies. the energy and the utilities by that, for that matter. You know, for example, if you look at Duke Energy, it's the same story.
Mm.
DUK.
I think Devon is playing a double dividend right now. They have a base one at like 1.5%, and then they're paying specials based on cash flow.
Mm.
I have a little question because I initially misread. I didn't read the email as carefully as I should have about investing. And then I started to research one stock, and which doesn't pay a dividend. And so I'm wondering, when do any of you invest in something that doesn't pay a dividend? Because I was looking at Berkshire Hathaway, and then you know, I'm wondering. I just bought a teensy bit of it for my wife, but do you guys ever buy something that's not, how can I say it, that's solid and has a very low PE and has a low beta and just kind of chugs along? Or is it always that you have to have a dividend? And what instances will you not you know, you will buy something that doesn't pay a dividend?
Jack, to answer your question, the whole charter of this particular
Right.
SIG is income oriented in the
Right.
sense that we are looking for
Sure,
stocks that provide a constant, sustainable stream of income.
you're right, yeah.
And
Okay.
so you're correct in buying Berkshire Hathaway, I'm sure, is an excellent choice, but it certainly, hopefully, will be beneficial to you from a capital gains point of view. And there's nothing wrong with that
Yeah.
by any means. But from an income,
Right.
sustainable, steady stream, it doesn't pay a dividend, you know, and so.
Right, I blew it. I didn't read it the first time today.
No, that's okay. No, you don't
Printed
have
everything
to.
up.
No, it's, and then the reason why I emphasize that is
Right,
thinking about investing in a particular stock really divides into two categories. Whether you're looking for it as an income, sustainable stream of income, the criteria, I think, is somewhat different than looking at it from a value point of view. And you're looking at it from a value point of view, and that's fine. That's nothing wrong with that. But if you want a steady stream of income, you know, you're looking for something that pays a dividend, maybe a
correct,
preferred stock or a bond.
right.
You know, so by the way, bonds in particular, this particular point in time might be an opportunity in disguise as well, because, you know, if the Fed starts to panic here in the third and fourth quarter and starts to cut the prime rate, the long bonds will look very attractive, because you'll not only get a very, very good yield or interest rate, but at the same time, you'll get some capital gains if you hold the bond. Now, assuming that the bond is not called, because in many cases, if the bond is callable within the next, say, year or two, then you know, it may not be such a good deal. But if you buy, say, a portfolio, an ETF that holds a bunch of bonds, let's say long bonds, you could do fairly well. But remember, that income is not going to be, that's going to be taxed at your ordinary income rate, not at your dividend rate, which is, you know, a lot different. So,
Well, last I looked, 2-year treasury was paying more than the 10-year.
what's that again?
I said last I looked, the 2-year treasury was paying more than the 10-year.
Yes, the yield curve is inverted right now, right?
Yes.
Yeah, and that's a perfect sign of a recession.
Andy, can you look at two different companies at the same time in fast graphs?
No, unfortunately, I cannot. It only shows you one at a time. What?
Okay, I'm interested in BHP and Rio.
Rio?
Rio,
RI,
BHP.
Yeah.
like Rio Tinto?
Yeah, Rio Tinto and BHP.
Okay, here's Rio Tinto.
That looks good.
Yeah, you.
Not
yeah.
for the future, though.
Yeah, you can see here that most of the analysts are forecasting a significant decline, and this is earnings. And if you, by the way, if you look at the sales, yeah, the sales are doing the same thing. So,
It's great dividend, though.
yes, but that dividend looks like it's going to be cut here and here and here.
Yes.
So from an income point of view,
Yeah.
not so good, not so good.
How about BHP?
BHP.
That's the copper one, commodities.
BHP.
P. Yeah, BHP. Yeah, there.
Okay. Let's have a look at that.
Same thing.
Same. Okay.
Yeah, see? So, these are interesting companies, but, from a sustainable income point of view, not so good, not so good.
Andy, could you look at Manulife Financial Corporation, symbol M as in Michael, F as in Frankie, C as in Connie,
MS.
F as in Frankie, C at the end, Connie. Yeah, that's it at the top.
Okay, all right. Well, that's interesting. Wow. Well, this is very interesting. A-rated company. Wow. I guess the question in my mind, the first thing this looks like something worth doing some due diligence on, to be perfectly honest, because here's the earnings. The earnings looks like it's growing at a fairly phenomenal rate. Very nice growth in earnings, yet the price of the stock has been fairly constant over here. So what is causing this? Is there some kind of a outstanding litigation against this company, or is there something else here that we don't, is Wall Street just ignoring it, or what? Because this looks like a bargain to me. Do you know any background on this at all?
I do not. I'm not sure. Is it an American-based company? Is one thing I'm wondering about.
No, I can't tell that from here.
Country Canada.
Canada, yeah, there we go. Well, you have some currency possibilities, but I don't think that would be a major factor. Interesting. This is an interesting company. Let's look at the operating cash flow. Looks pretty good. Gee, this is that's a good one.
Wonder what happened in 2010.
What's that?
Wonder what happened in 2010 and 11, that huge drop.
Yeah, looks like it took a hit, and yeah, but still, even though, if you take the nominal price to free cash flow, which is this blue line here, it's below that. That's interesting. Yeah, might be worth doing some due diligence. If you want to take a homework assignment, go do some homework on this and come back next September and tell us all about it.
Okay.
Yeah, this is looks interesting. Yeah, this looks like Allstate, kind of similar thing, or Prudential. Prudential, I think, has a similar pattern. Let me look at Prudential, because I was kicking in the tires on this one too. Yeah, that's not so good compared to free cash flow. Let's see, let's go look at the operating earnings. Operating earnings are growing, but the free cash flow is declining. So that means, yeah.
I can't remember. I was reading about this a couple weeks ago in Morningstar, and it sounded terrible. I can't remember what I read, but it did not sound very appealing projection, because I was for a long time interested in it. And Morningstar was, I can't even remember, but I got turned off completely.
You know, I think this is a stock that's recommended by AAII dividend newsletter too, as well. You know, I don't know what they like about it.
I think for a long time it had better days. And it had a high dividend. People were using it almost like a bond. But
Yeah, 4.9. Yeah. Mhm.
There's a new stock, I mean, excuse me, a new entry to the aristocratic 55-65, which is Brown and Brown, which is also in insurance. I think it's more insurance brokerage, but they just joined the aristocrats.
What's the symbol on that? William?
I don't know. I just know it's Brown and Brown.
Oh, there it is. Okay. BRO. That's interesting. Well, it looks like it trades close to its nominal price to earnings ratio, which is 22. That's this blue line. So, you know, if it gets down to, let's say, $53 a share, you know, it might be of interest. It's got an impressive growth record. Let's see what the operating cash flow is. Yeah, it looks pretty good. BBB minus, is that what I'm seeing there on the?
Yep.
Yeah, so I would have to start looking at the credit rating, see what the you know, what it is that people are concerned about here. There is a way you can do that in fast graphs. If you look at balance sheet here, long-term debt, let's say. Oh yeah, you can see the debt is skyrocketed. And then if you add the let's go to EBITDA. Let's go to EBITDA. That might be a better earnings before interest and taxes. Let's see. Well, let's go EBIT. That might be just. Well, it's not too bad. The thinking here, by the way, is the blue line is or the purple, I think it is the debt structure. And, you know, you can see that it has grown quite a bit over the last 5 or 6 years. But the earnings before interest and taxes has grown also. And so what you're trying to do is look at the ratio between the EBIT and the debt, the total debt. If the ratio is more than, let's say, 5 or 6 to 1, that makes the creditors very, very nervous. And you can see here that that's not there yet, but maybe that's what's caused some of this price fluctuation. You know, you'd have to look into it more deeply to get some picture of it, but that's probably why the creditors are giving it a downgrade in the credit rating and so forth.
Yeah.
Well, we're approaching 3 o'clock here. Do any other commentaries before, you know, I can go on for another half hour or so if you want, but what do you guys want to do? Want to wrap up here or not?
I'd like to keep looking at stocks, but that's just me personally. I'd go another half hour.
Okay.
I also wrote down, if you guys want, what are the upcoming Fed meetings? And if you want to just jot those down, the next four. The next one is on 7/27, and that's expected to go up 75 basis points. And then the next meeting after that is going to be, this is the FOMC meeting. The next one's going to be 9/21, and they're expecting a 0.5% increase. And then the next meeting is 11/2, and because of the election, they're not expecting an increase. And then the fourth one is on December 14th, and they're expecting a 0.25 increase. And that's just what they're looking at right now. But I forgot to pass that along. So the 27th of this month is when we've got our next Fed meeting. Because it looks like when they do that, the Plunge Protection Committee kicks in and kind of helps stabilize. For what it's
Well,
worth.
you know, to me, when the leading indicators start to go negative, that's a time that when I think the Fed will start to stop their increasing their rates, and that's the time to look at opportunities in dividend stocks, or by that matter, bonds.
Yeah, I
And by the
agree.
way, this is the Econ Pie chart, which is something you should visit on a regular basis. The green dot here is the leading economic indicators, and you can see it's in the decline stage, but not in the contraction stage. So when this green dot shifts down into this quadrant here, that's a sure sign for our recession. And you can see that the median for all the economic indicators, which is this group of indicators here, shows that it's in decline. But will this shift down into here? That's an open question. That's an open question. You know, if you believe the pundits, you know, we're heading into a recession. I don't know. I'll believe it when I see the green dot move along the line, or you know, just listen to what Gilbert Ho has to say. He's done a good job.
But let's face it, the first quarter and then now the second quarter's in, and they'll in the future revise the second quarter negative. So we actually have our 2 quarters in a row, which technically is a recession. So we actually we're in a recession, as I see it. But
Well,
it's just not officialized.
Yeah,
You know, they revise stuff down.
yeah.
It's my 2 cents there.
If the yield curve inverts, that typically is a pretty good indicator for a recession, you know, and it's almost there now. I think it may even be inverted. I don't know. Maybe you guys know.
Andy, the consumer sentiment based on CPI,
What's that?
is a consumer sentiment based on CPI?
I think so. Does anybody know that?
When is the CPI coming out?
The CPI comes out around the middle of the month, doesn't it?
I think it's the 13th of July.
Okay, so that
Okay.
will, that we need to watch that too, right?
Mm-hmm. Yeah. 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 If you look at this chart here, yeah, they're all yellow except for vehicle sales. I guess are still holding up pretty well, and so are industrial capacity. So,
Well, I'm keeping an ear out for layoffs. When we start hearing about layoffs, we'll know we're there.
okay. Leo, you say?
Layoffs, you know, I'm laying off my workers
Oh, okay.
in the business. People can't afford my product.
Hmm.
Or, you know, the trucks aren't coming. There was 2 disturbing videos I'll quickly share. One was a really high-level guy who invests in insurance, and he was talking about life insurance companies. And he listed 4 life insurance companies that had to report how bad all-cause mortality currently is. And he was saying it was like a 6 sigma or a 2 sigma event, but he was saying that the death rate now for like kids 15 to 49 was 40% higher than normal, 40% higher than like a 5-year average. So that was really disturbing. And the other disturbing video I saw was the guy who owns all the truck stops in America. The CEO was talking to a congressman, kind of like a Senate hearing type thing. And he was really pissed because he orders all this diesel for all the trucks that come to his truck stops. And the railroad that delivers the diesel said, we're cutting you back 26%. And he goes, well, you can't do that. You're going to get sued. And they're like, yeah, that's fine, sue us. So that seems pretty disturbing that there's kind of an artificial diesel supply problem kind of just artificially created, in addition to all the other craziness with, oil from Russia and stuff like that. So, energy is a huge, scary thing right now. And it turns out China has increased their oil purchases from Russia 55% year over year, and India has as well. And I think an area for me to look for a good dividend stocks would be in India. All I've got is a computer company there, Infosys, and I've always looked at like Dr. Reddy. I don't know if it's any good or not, but
So
yeah.
Rich, do you have you say India? You say India?
Yeah, the country of India.
Okay. So do you have a shopping list that you have
Well,
put
there's
together?
the one company that I've never looked at. I haven't really researched it too much. The trouble is I go off a value line and they don't really do much in the way of international companies. There's like, these refineries are tuned to a particular oil deposit. And so when you switch, getting your source from say Russia to, the new guys, you have to redesign that whole infrastructure. And so that's going to be a really good investment area. And I look like in, some of those Saudi Arabia type countries, and they don't show anything, so it's kind of bizarre, but it's almost like our world is being chopped into these blocks now. And, and that's an area, that looks really good. We've got a very strong dollar, and I don't see that lasting because, countries don't really want to hold our treasuries anymore because it's like, well, what if the United States gets angry with us and then they sanction us and then take our money, So a lot of these people aren't happy holding our reserve currency. And then you've got countries like Russia that paid back all their IMF loans and said, well, now if you want to buy my oil, you're going to have to open up an account at the Bank of Moscow and pay me in rubles or gold or something like that. We're not on the treasury system anymore, or the petrodollar system. So I don't know. There was one stock I also heard in one of those things where they were talking about the stock symbol X, which is I think U.S. Steel, and they said that company is debt free, and I'm like, a debt free steel company with like a closed captured market. I don't know if I believe that or not. Oh, look at that.
Well, that's the cash flow.
That's a rough ride.
Rich, I would stay away from this one.
Yeah, that looks like a shark infested lake.
Yeah.
Yeah, I don't know if you could type in, or maybe I could find a stock symbol. What's the stock symbol for Dr. Reddy?
Dr. Reddy?
Yeah, no, Siri doesn't know. But yeah, it's called Dr. Reddy. It's a pharmaceutical company in India. Very profitable.
It's kind of a generic, they produce generic medicines.
Yeah.
R-E or Dr.
EDY.
Reddy?
R-E-A-D-Y. Yeah, just like I'm ready.
RDY, I think.
RDY,
Or RDY.
Robert David Yellow.
Oh, the symbol is RDY. Yeah, that rings a bell.
I just looked it up.
Oh, there it is.
It said US, huh? Okay, that's overpriced too.
Well,
Earnings are up.
there's no rating on it, so
Yeah.
Doesn't pay much of a dividend, so,
Yeah, it's not a keeper.
well, from a capital gains point of view, maybe it might be worthwhile, but from an
Yeah.
income point of view, it's of no interest to me. I mean, but,
Right. Yeah.
But,
Well,
but
well, Andy, you asked us to look for beaten down income stocks. I don't think you just meant the aristocrats. So I came up with one that's totally been beaten down. It's got a little bit of negativity to it, but it's a great dividend payer, and that's Altria.
Oh,
that's,
I own it. That's a good one.
Altria, what's the ticker symbol? Is that
Mo.
Mo?
MO.
MO? Oh, I bet that's a good one. Yeah.
Philip Morris.
Oh, look at that. Oh my gosh. That's, oh, look at that, 8.6% dividend.
Yeah.
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 It's investment grade, slightly above investment grade. Yeah, that's a good one. Let's see.
Up was because of FDA ruling on Juul.
Look at the, yeah, that's are they the ones that are involved with Juul?
Yeah.
Yes.
But
Yeah.
it's really not hitting their bottom line. So it's more of a news item rather than a dollar item.
Yeah.
Well, the
Maybe I
stock
should-
looks like it's taken a dip here quite a bit, yeah.
It's a good buy right now.
Cash flow wise, it looks very good, yeah.
Can you check Philip Morris? It should be similar to Altria. PM.
Yeah.
Yeah.
PM?
Yeah. Yeah. Paul Mary.
I thought they were the same.
No,
No.
Philip Morris, I think, is international.
Oh,
I think
Yeah, they're two different ones. Yeah.
Is US and Philip Morris, I think, is international.
I guess I figured if they can't get rid of cigarettes, they're not going to be able to get rid of Juul. That was my basic thought on it.
I think it's looks like a good one, William. Are you going to take a position in it or?
I already have a position. I was just thinking about adding.
Uh-huh.
Mhm.
Well, Philip Morris doesn't look quite as attractive. I see its earnings growth is 5.27%, but it's a little overvalued. Maybe if you waited a little bit longer, you might get it at a say, $82, maybe something like that. Nice steady earning dividend growth, but looks good. Yeah.
Andy, can you type in British Telecom, boy, Tom, India?
What kind? Give me the ticker symbols, please.
Yeah, boy, Tom, India, BTI.
VTI.
No, B as in boy. Tom, India, BTI, British Telecom.
Oh,
American
British
Tobacco.
Telecom.
No, sorry. That's the right one. American Tobacco. Yeah.
Oh, British Telecom. Okay.
American Tobacco.
Yeah.
Well, it looks like they took a big dive here in price back here in 2018. And then it looks like it's stabilized. 7% dividend. That's pretty nice.
Right. Yep.
It looks like their dividend is forecasted to decline slightly here. Not too much. 448, 445.
I've owned it for years. It just keeps paying. And
Right. Yeah, it's a good solid company. I don't know what happened back here before 2018, but it's a stable company, good dividend. I think it's up like 3.5% for the year. So flat almost, but good dividend.
Yeah, looks interesting. What's the operating cash flow? Pretty good. Cash flow,
Bless you.
still pretty good. Yeah, that's,
gotta love those sin stocks.
yeah. Those tobacco stocks are, yeah, look interesting. The other area that, the sin stocks, talk about sin stocks, the distilleries, and usually do pretty well in a recession as well. People drink more or return to drinking or whatever, you know, so, yeah. That's a possibility too.
I have a question on corporate bonds.
Okay,
So dividend stocks versus looking at like 5-6 year corporate bonds, investment grade, triple B and up. I was doing a search on Schwab site. I see about 4, 5, 6% yield. What are your thoughts on that? Those?
Well, I've been looking at corporate bonds as well. What's the term on those? 6 years?
Between 4 to 6 years. As a matter of fact, I saw Delta Airlines, which was like 4 years out, 2025 or 26, so let's say 4 years,
Okay,
paying about 5 to 6%. I don't see it anymore, probably sold down, but those guys, I mean, even though it was downgraded, but I don't think Delta Airlines is any jeopardy of going bankrupt or stopping payments on the bonds. At least that's my thinking without further research. So that's why I was curious.
you know, I looked at corporate bonds against muni bonds about a month ago now. I think I may have even mentioned it at the June meeting. At that particular point in time, you could buy a muni bond fund for more, it was yielding higher after taxes than you could buy for a corporate bond. And that's unusual. That's extremely unusual. And after digging a little further deeper, what's been happening is when the Biden administration poured all this money back into the states because of COVID and to boost the economy, it drove the price of corporate muni bonds or muni bonds down to the point where the yields are up significantly. And so that was a very attractive, and I mean, I'm not in a high tax bracket at all. I'm not in a bracket where I would even consider, you know, muni bonds, but boy, that was tempting. I'll tell you that. But I think, you know, if you're looking at corporate bonds, what is the term of the bond and is it callable? When is it callable? That's a question that you have to ask.
Right. So I looked at that. As I said, term is about 4 to 5 years. And I looked at the call feature. So there are two columns. One is yield to maturity, and the other one is YTW, yield to worst. So the way I understand is that if the bond is callable, and sometimes they say they will make it whole, meaning that compensate for the price. And if the yield to maturity and yield to worst are the same, that means the call feature will not impact in terms of your return. So from that perspective, and the interesting part was the due date and the call date were like 2 months apart. And I said, not a big deal for a 4-year bond, 5-year bond. 2 months, I don't care, even if they call it 2 months early. So that was, at least the bonds I was looking at, was not a factor. But you are right, that needs to be looked at in general. So that part is correct.
Yeah, that sounds interesting, and certainly one that you should look into. The other thing that you might want to consider is, what is your after-tax income on that bond versus some other dividend-paying stock? Because your corporate bonds are going to be taxed at your normal income rate, not at the 20% or 15%, whatever it is for a dividend stock. So
Right.
that's a trade-off that you know, from an income point of view, that you need to do. If it looks attractive, then it's a deal. You know, it's a good deal. Yeah.
So Andy, that brings a bigger question for. I'm not a big dividend investor. I have some portion, but a small portion. I have some bonds individual bonds or bond ETF, but mainly individual bonds. Without getting into much detail, not looking for any personal information, but do you just invest in dividend stocks as opposed to the bonds or any other type of fixed income?
I have some fixed income, not much,
Okay,
but mostly as dividend stocks. The downside, to be perfectly honest, is when you invest in a dividend stock, you need to do the due diligence on the individual stock.
right,
Most people don't want to bother with that. So they buy an ETF or a mutual fund and let some professional manager manage it. And that's probably for 95% of the people, that makes sense because they don't want to spend the time with it. I love doing this. I enjoy looking at the financials for a company and trying to determine, but 95% of the people don't do that, So,
Good.
like SCHD, I mean, that's a very good,
right.
yeah.
Yeah.
So, but and I think that, if I could encourage everybody in this group to look at the financials, I think you'll find that there are bargains out there all the time, no matter what market conditions or what the economy is doing. It's just a matter of looking. But that's just me. I wouldn't impose that on anybody because it does take a fair amount of work on my part. I mean, I have to do it, but I enjoy doing it. And it's just my fun thing to do.
And when you buy and hold these stocks, you hold it for a long time, meaning could be 10 years plus?
Yes, I tell you, my answer is forever if I can. Yeah.
Okay.
Yeah. If they cut the dividend, then or if it looks like, if the cash flow looks like the dividend is vulnerable, then I'll take a hard look at it. For example, AT&T. AT&T was a huge problem for me. I was going to sell it, and then I decided to hang on to it despite all the, they sold DirecTV, they sold the Time Warner portion of it. But still, the dividend is fairly substantial. It did get cut. It's the only dividend stock so far that's cut its dividend in my portfolio. But I decided I would live with that, so because it's still, even after the dividend cut, it's paying a fairly substantial dividend. So, but normally the answer is no. If it looks like the dividend is going to be, if the free cash flow does not cover the dividend, I'm out of it. I'm out of it completely.
All right.
Because figure it out. Your dividend stocks are taxed at 15% or 20%, depending on where
Right.
what your tax bracket is. You won't find that anywhere else. Even capital gains maybe 20% if you're having a situation, but it's not sustainable. You can't expect to have capital gains like that year in, year out. I mean, you even in a mutual fund or a dividend stock, or excuse me, a ETF, right now, for example, most ETFs are negative, and so you're in a cash position. Well, from a cash flow point of view, if you're depending on the income, not so good, not so good. But if you have enough built up over the last 10 years or so, then it's not a problem, and you can sustain it. I don't know. Our charter here is, for income oriented, so that's kind of what we stick to, and that's not to say that another approach is better or worse. It's each one is different.
On June 21st, I bought a Treasury I bond, and that's where you go to the treasurydirect.gov site. And for the price of filling out a form, you get 9.62% APR right now. That's the one that bumps up and down along with the consumer price index. And because inflation's so high, it's, 9.5% is going to double every 7 years.
Yep,
If I look
absolutely.
at my checking account at Wells Fargo, which is like 0.01 or something, that'll double every 750 years.
Yep.
So the first 10,000, I would say go to treasurydirect.gov and buy one of those I bonds, and for family members too, and letting other people that are coming to us, since we're kind of the experts, is a sensible place to put some money. You got to leave it there for at least a year, and it's a 30-year bond, and there's a minimal penalty if you you have to pay 3 months worth of interest if you want to pull it out before 5 years. So you got to hold it for a year, and there's a penalty, but none after 5 years. And the interest penalty is nothing. It works out to like $20, $25 on the $10,000 investment. But it could be like your kid puts in $25. It just gets him saving, and you could just add to that. And then if you want to be like at expert level, probably like Ron, you somehow put extra money in with your quarterly payments to the government, and then when you do your taxes, you can receive another $5,000 in IFA. So you can actually do $15,000 a year if you're cagey. But for me, $10,000 a year, is a great deal, especially at 9.62%. For something backed by the full faith of government.
Is that locked in, or is that change every quarter?
It changes every 6 months.
Right.
And if you go to the site, you can see what it's been paying for like the last several years, and it's been paying very well. It's kind of a hybrid rate, but it's good till it's not. So I figure it's good for me for right now, and if nothing else, it's a place where other family members, I'm encouraging all the nieces and nephews to just go to the screen and fill out the form. You got to put in your name, address, driver's license, social security number, and then, wire it in or, transfer it like an ACH from your checking account. And then it's just, you go online and you can look at it. And then when you can withdraw it, after the 1 year. But real makes sense. And it's just a lot of people don't know about it. So I figured I'd make mention of that, because who doesn't like, a return of 9.5%?
So Rich, what happens if the interest rates start to decline? How does that bond affect? How does it affect the bond?
Yeah, if the CPI goes down, then the rate goes down.
But
So,
the bond value goes up, doesn't it?
Well, no, it's not like a TIPS. It's not like it's a discount or premium like a TIPCO bond. It's basically like those old H bonds, or the HH bonds. Basically, you have your principal and they pay you interest on it, and the interest is adjusted every 6 months. It's made of a fixed rate and a variable rate based on inflation, and basically the whole rate comes from the inflation. It's pretty easy, pretty simple. It's the worst thing I found was the site. If you hit your back arrow on your browser, it kicks you out of the system. You must use the button on the screen for forward and backward. But there's a video on there, and there's a nice little explainer video on YouTube. If I can think of how to find it, I'll put it in the chat. But it's the guy who runs the Wealthion channel on YouTube. If you searched on Wealthion and iBond, I'm sure it would pop up. And that's like a 20-minute video on it. Or just go to the site, and all the frequently asked questions are answered. They made it, I think that, they just put something out there so they can get, I don't know, sensible. You're limited to $3 grand.
And actually you can buy as a gift, husband can buy for the husband, vice versa, wife for the husband, etc. So that can add to the 10,000 to what you were stating, Rich.
That would be at a separate Treasury Direct account for each of those, because each person is limited to 10,000. And the other notable thing is, as far as like our tax equivalent calculator goes, there's no state income tax whatsoever. So
Right.
as far as Oregonians go, that'll save you 8.75% tax rate there. Because that's zero. All you do is you pay your federal tax when it comes out.
And the good part about the gift is that it starts earning the interest now and incurs the timing, starts the clock right now. So
Exactly. And then that is the most attractive part because you get the rate even before you gift it, I think.
yes,
Hey, Rich, does it compound? Or is it just added to the
It
base?
compounds semi-annually.
No, but
If you wanna think of it that way.
so the front loading you're getting now is actually going to compound.
So I bought 10,000 and then I'm gonna get like 4.5%, right, in 6 months.
Right,
And so then I believe what happens is then the principal, then the next 6 months interest is based on that
10,040 bucks.
$45. Yeah.
Okay.
Yeah.
Okay.
It could be annual. I'm not an expert, but
No,
I do remember it was compounded, but not monthly,
okay.
or daily or any of that.
But in a way, the reason I was asking that is if you're really interested in those, even if the rate's going to go down, which was one of the questions, it doesn't make any difference because you're front loading at least 2 6-month periods of fairly high interest, which are going to compound forever. Even if the rate drops to 1%, you're compounding that 6% or whatever it is.
Yeah, it's a good deal, isn't it? Yeah.
And the hardest part is just filling out an online form by the government.
So you can't buy these through your broker. You have to go direct, right?
Correct.
Yeah,
Correct.
right. And you won't get any paper on it. A lot of things are going that way, which I'm not crazy about. But yeah, so I did a screen grab or a print. It has a button where you can print it out.
I think if you do the ones on your income tax return, they're paper.
That's right. Yeah, I did read that. Yeah.
So do you get some kind of a 1099 or something at the end of the year, or what? How does it?
Probably.
Government? Huh?
Probably. You'd have to.
Mm-hmm.
Yeah.
Well, we're coming up on 3:30, guys. Any other comments before we wrap up here?
Well, that thing just snowballs. It's not like they're paying the interest like semi-annually, like a normal bond would. It just goes into the bucket. You know what I mean? It just keeps getting added. But no, good. Trying to get a lot of people encouraged to do that because a lot of people are like, oh boy, what's going on with the stock market? I'm like, well, do that. At least helps a little, especially for the younger kids.
Okay, I think if anybody else had any comments before we wrap up here, we've had a very good session considering how sunny it is out and everybody's still interested, I guess. We'll meet in September. I'll send out a notice. I think it's probably going to be the Monday after Labor Day weekend. I don't know what that is, maybe the 10th or 11th. I'm not sure. I have to look that up.
There. It'd be the 11th.
11th, okay.
Yeah.
So September the 11th, mark your calendars, everybody. And we'll meet on that date. Hopefully we'll have some more things to share. Hopefully we'll have something to say about the community software, and who knows, maybe our spreadsheet will be available or whatever. And then of course, keep looking for opportunities in the skies, because that's how we make money here. So have a nice holiday. We'll see you in September.
Okay.
All right. Bye-bye.
Yeah, everyone.
Bye-bye.
Bye-bye.